Okay, well, it looks like I didn't schedule a webinar for today. However, I fully planned on having one. And so you're probably going to get this through a link in an email. I'm going to try and send this out to everybody. Have to see how big of a task that is. But I apologize for the confusion. Anyway, welcome to the January 3rd edition of the Fats, Fuels, and Oils webinar. I hope everybody had a good break and enjoyed the holidays. This week, we're going to start sort of a new format for the webinars where I'm going to put together a presentation and then we'll go through that. This week, I don't have the report published on the website just because we were off yesterday, which I suppose is why I didn't schedule a webinar for today. But going forward, the report will be published Monday night, and then we'll go through this. And if there's anything on the website that we want to look at after we go through the presentation, we'll look at this. I'll try and keep the presentation relatively short, but as I was putting together today's presentation, I noticed that I ended up with more slides than I probably wanted to have anyway. Let's get started. All right. Okay, and I apologize for not scheduling this. I thought I had, and I fully intended to, and I didn't even look when I started this. I'm actually in the January 10th webinar, so I may have to reschedule that one. I don't know, but I'll figure it out, and then we definitely will have one next week. Okay, so what is going on? I wanted to start off again with a review of what's going on in South America. You can see here, this is where Argentina generally grows soybeans, and it has been dry. The rainfall that was expected for the end of December didn't really materialize, and there isn't really a lot of rainfall forecast through the first half, basically, of January. The ENSO forecast for the La Nina still suggests that La Nina is going to end sooner rather than later, but given the dryness in Argentina, farmers have delayed planting and or have planted into dry ground, which hasn't received rain for basically emergence. And while the Argentine planting window is fairly wide, given that it doesn't look like it's going to rain a lot through January, it looks like at least the crop is going to go into dry ground and is going to need lots of periodic rainfall throughout the year or throughout the growing season to produce a crop. You can see right now the Buenos Aires Grain Exchange is projecting a 48 million ton crop, and we are down at 39. Now, I think 39 reflects sort of the lower end of possibilities. And if it starts to rain in mid-January and we get good rain through the season, I probably will end up bumping that up a bit. But given the outlook right now, I think 39 is probably a realistic number, and probably what the market has started to price in. The recent rally in soybean prices, I think, had more to do with strength in soybean meal demand and strength in soybean meal prices than it did with South American weather, especially given that Brazilian weather is generally good. But if it continues to be dry, I would expect that the price risk for soybeans, soybean meal, and most importantly for this call, soybean oil, would be to the upside. Now, we still think that soybean oil, fair value for soybean oil is around 65 cents. And you'll see when I put the forecast up that we've got prices relatively flat, maybe even declining a little bit through the year around that 65-cent level. There are a couple of things that could change that fair value. One, obviously, energy prices. If energy prices move significantly higher or lower during the year, that would have an impact on soybean oil prices. And then two, soybean prices. Again, the historical correlation between soybean prices and soybean oil prices has changed, but there still is a high correlation between the two. So higher soybean prices tend to mean higher soybean oil prices. Okay, so that's Argentina. All right, for Brazil, the reason that I have Brazil up here, even though things are going relatively well, at least in the middle center section of the country, what I wanted to point out is how much production is really in the southern three states of Brazil, and in particularly Rio Grande do Sul. So you can see in December CONAB forecast that production in Rio Grande do Sul would be 22 million metric tons. In the three states combined up through Paraná, production is about a little over 40 million tons, or expected to be a little bit over 40 million tons, which is about 30% of anticipated production. And southern Brazil, particularly RGDS, the crop is basically a function of the same weather that you get in Argentina. If you go back to the Argentine growing, where they grow, you can see that basically the main growing areas in Argentina pretty much line up with Brazil. Paraguay is also a bit of it's kind of an in between sort of the where we are between some of the larger growing areas in Brazil and Argentina, and its weather kind of reflects that. So it hasn't been, there haven't been perfect growing conditions in Paraguay this year. Now, Paraguay doesn't produce a lot of soybeans, but if we're going to get down to 39 million tons in Argentina, and if we lose half of the Rio Grande do Sul crop, which is probably a little excessive right now, but let's just say for the sake of arguments, we take 10 million tons out of production in the three southern states in Brazil, then the Paraguay crop starts to become pretty important. And while Paraguay produces, if I'm remembering correctly, they produce a little bit more than, well, maybe about 15 million tons of soybeans. If you take 5 million tons out of Paraguay, then things start to add up pretty quickly. So then you're taking 11 million tons from expectations out of Argentina. Call it 10 million tons out of Brazil. So you go from 153 to 143, something like that. And then you take 5 million tons out of Paraguay, you're up to 26 million tons of production out of 160. And so that would be significant. Now, I don't think that would be significant enough to make soybean prices go to new record levels, but I do think it would be significant enough that soybean prices probably would test the highs that were set last summer. Whether soybean oil prices follow and test the highs will depend on a bunch of things, but it will depend on profitability of biofuel production, non-biofuel demand, and South American crush and world soybean oil demand. So there is a chance that you get soybean prices going up to test new highs, and if all of those things tend to lean bearish, then you could get soybean oil prices that go up sort of close to the highs, maybe above 70 cents or so, but not necessarily significantly higher than that. All right, so this is the output from the GFS weather model, which is one of the big models used to predict forecasts. So the local news that that you may or may not watch every night uses the GFS model, or this is one of the models that they use to predict your local weather and my local weather as well. And you can see here, this is the 10-day rainfall totals for South America. And you can see that in Argentina, particularly in the main growing areas, you don't have really any precipitation. The forecast for the next 10 days calls for 2.6 millimeters of precipitation, which, if I do the math, the conversion correctly, is about 1/10 of an inch. Maybe doing that right. I think it's 2.6 centimeters or roughly per inch. And so that's not enough rainfall to make any difference at all in soil moisture levels. And in fact, if this forecast verifies, soil moisture levels in Argentina will continue to decline from already really very low levels. Now, the other thing that's important to point out here is that you do see some rainfall in South America or in southern Brazil. However, that still is not significant totals for 10 days at this time of the year. You can see most of the country is, or most of the significant growing areas are getting an inch or two of rainfall, which is much more typical for this time of the year, and is what you really need to sort of support soybean development, unless you have really built up soil moisture levels, which they also don't have in southern Brazil. And Paraguay kind of, again, sort of a bit of half and half. Paraguay is kind of in here. Good rain, at least over the next 10 days, but has again kind of gone back and forth between sort of more Argentine-like weather and more Brazilian type weather. If Paraguay gets this rainfall, then I would expect that the crop losses in Paraguay probably will be limited, although again, all of this will depend on sort of follow-on rain throughout the rest of the season, except for sort of center west Brazil. Not that they don't need any more rain for the rest of the year, but they've had enough rain, soil moisture levels are good, the crop's developing well. Timely rainfall for center west will produce a really good soybean crop, unlike the last couple of years. And so Argentine production is really important because Argentine crush, as you can see from this chart, has been running relatively low compared to the 5-year average or the last couple of years. Now, I was a little bit surprised at how high it was actually in November. It was significantly above where we had it. I came in at like 3.3 million tons, and I think we were at 2.75 or something like that. So it was well above where we expected it to be. And you can see from the 5-year average that seasonally you typically get a big decline in Argentine crush starting in November and running through the end of the year. We still have that decline built in, sort of extending through January before we start to rebound. But if the crush continues to come in above our expectations, then that's one of the things that potentially could be bearish for soybean oil. Now, the one thing that limits the impact of crush just a very, very little bit in Argentina is yields. And I'm going to talk about soybean oil yields a little bit today, a little bit more than I typically do, because yields are sort of one of those numbers that are maybe a little bit in the weeds for for most analysts. Most people that aren't analysts that their only job is to pay attention to this stuff. And while we've talked about canola oil yields and soybean oil yields in the US, we haven't really ever talked about Argentine soybean oil yields. And while Argentine soybean oil yields aren't as low as the yields that we've seen in the US or in Canada, and in particular in Canada, since we're relatively well into the new crop versus the US where we're just getting into the new crop, they are lower than they were last year. And if that continues, then this higher crush doesn't necessarily produce as much soybean oil as it would have last year. And that tends to leave the world market a little bit short. Now in Argentina, the decline is not so much. It's like from 19.7% to 19.4%, it looks like, from 21-22 to 22-23. And we'll see what next year's yield looks like. But it is something that it could be important given the fact that it looks like canola oil yields are going to be low in Canada, and US soybean oil yields have the potential to be low in 22-23. Now, the other thing to notice here is this Argentina is on an April-March crop year, so this isn't OXEP. And so to finish out the year with a little bit lower soybean oil yields isn't that important. And what will be significantly more important is what the yields look like out of the next crop. And again, typically if you have hotter and drier than normal weather, that tends to result in higher yields, higher oil yields. And so if Argentine weather kind of continues the way that it has, then we would expect oil yields to go up, even if the crop is smaller. Now, if La Nina fades and we start to get more rainfall and maybe cooler temperatures in Argentina, then you could have a situation where the crop got off to a bad start. You didn't really ever get sort of good emergence, and so the crop's potential is limited. Maybe it doesn't come down as much as we're expecting, but it still comes down. And you also have yields next year that are significantly below this year because it would be cooler and wetter than normal. For 22-23 OXEP, we're predicting 40.6 million tons of crush for Argentina. That's raised a little bit based on some increases that we made based on the November data. And you can see that, again, there may be room to increase that if December comes in close to November and things are a little bit more straight line, or even decline a little bit less than we expect over the next couple months. So this is Argentine soybean oil exports, and the main point here is that while we expect, and again, based on the April to March marketing year, we're through a big chunk of it. Argentine soybean oil exports are going to drop dramatically by 600,000 tons, a little bit less than, or a little bit more than, from 21-22 to 22-23. Now, Argentine soybean oil basis has been really, really weak. And so despite the fact that you're seeing these lower exports, or maybe these lower exports are a bit of a function of that, that suggests that world demand hasn't been as strong as it was in the last couple of years. And so the impact of the decline is going to be much less important this year than it would have been if we had done it, particularly, I think, in 2021, coming out of the pandemic when the world was really short vegetable oils. And so while the number is important and it looks significant on this chart, given where we are with the world supply and demand right now, it may not be as important as it otherwise would have been. Now, we expect a bounce back in 23, 24, but of course, a lot of that will depend on ultimately the size of the soybean crop and the oil yield, and then also on world demand. And again, we've got 22, 23 OXEP Argentine soybean oil exports at 5.5 million tons, essentially. All right, so U.S. soybean crush. Later today, we will get the monthly fats and oils report, which will tell us exactly what the November crush was. Based on the NOPA data, November crush looks like it was essentially in line with the last couple of years. But what's important is what comes out over the next several months, I think. So typically you get a peak and crush, at least on an average daily basis in November or December. Maybe you get another little run up in February, and then you start to tail off after that. And our crush forecast is based on a 2.235 billion bushel crush, which is just below where USDA's December forecast was. Now we'll see what USDA does with their forecast in January when they release the next WASDE report. And part of that probably will, any changes they make will depend, of course, on what the December numbers are. But given that they were relatively lower than we were earlier, or before we reduced ours, it wouldn't surprise me if they reduced theirs. Now, I think we cut 40 million bushels out of our crush forecast for 22, 23 in the last month or so. But I don't know that I think that USDA is going to need to cut theirs by the same amount. I think they can probably get away with a smaller cut than we made, but they probably will still end up a little bit lower than us on their forecast. Okay, so the big question, I think, is what will soybean oil yields be for the US? Again, we're into the canola crop enough that we probably have a fairly good idea of what we think canola oil yields are going to be. But the NOPA data, as you can see, suggested that we saw a big drop in soybean oil yields from October, which is essentially crushing the crop from the prior year, to November, which starts to get a lot more new crop, and given how tight soybean stocks are, maybe almost entirely new crop crushing. And we're still kind of optimistic for the rest of the year. But I would say if the January NOPA report suggests that that the oil yield is going to be closer to 11.6, maybe 11.65 or something, than our 11.75, then we're going to move all of this down to somewhere between probably 11.6 and 11.7 through the rest of the year. You can see kind of typically you get a little decline and then yields kind of build through the year. And so if we start off, if November's at 11.6, then we probably build it slowly and get up to 11.7, maybe a little bit over 11.7 through the rest of the year. It's important because for each 1/10 of a pound of yield per bushel that we lose in yield, it reduces soybean oil supplies by 225 million pounds. And so 225 million pounds is more than 10% of our anticipated carryout for 22-23. And if we go from 11.8 to an average of 11.65 or something like that, then that's going to be 337 million pounds or so. That's a significant difference, and that makes making the 22-23 US soybean oil balance sheet balance a little bit tougher, particularly given what we're seeing in demand for from non-biofuel users and the margins that we're seeing from the biofuel users, particularly in biodiesel. And I'll talk a little bit more about that at the end. But biofuel margins remain relatively good, and or in biodiesel's case, kind of historically high. Renewable diesel kind of continues to move down to biodiesel, and that's something that I think probably continues. But if we start to cut supply, it's not really clear where the reduction in demand is going to come from. And that is the one area where if the South American crop is smaller than expected and the US domestic demand essentially needs all but 1.1 billion, 1.2 billion pounds of US soybean oil supplies. And so their US exports aren't really go down by 500 million or so pounds, even given that right now world veg oil supplies are plentiful enough that Argentine basis is still really low, and it looks like the world is well supplied with vegetable oil. You take another 500 million pounds out of the US, then the South American crop becomes important, especially if production and crush fall to a level where soybean oil exports out of Argentina and Brazil don't necessarily make up the difference. And so then you have the world turn from neutral to bullish, and you have the domestic situation get more bullish because non-biofuel and biofuel aren't necessarily going to back down. Now, we got the EIA data for October, and what that implied was that non-biofuel demand in October was like 1.3 billion pounds. Now, based on our assumptions for November, we've got that dropping down to just over 1 billion, like maybe 1.1 billion pounds. And that, again, the non-biodiesel demand is a really volatile series, and so it tends to be better to look at it in sort of averages of quarters or whatever. But so if the first quarter average is around 1.2 billion pounds, again, that is in line with a marketing year total demand that is above 14 billion pounds. And while expectations for biofuel feedstock demand have come down based on the EPA data, I think there's an argument to be made that maybe the market's initial reaction to the EPA report was wrong, and now this recent rally, or the rally off the lows in soybean oil, is the market kind of reassessing what's going on with the EPA and kind of picking up on the idea that we probably aren't going to substantially reduce biodiesel capacity, and we probably are going to increase renewable diesel capacity, and the renewable diesel capacity that comes online is going to run no matter what the mandates are. And so that renewable demand, I think this year, probably we're in a situation now where expectations for renewable demand, renewable feedstock demand, creep higher through the year, as opposed to the last couple of years where we've started off relatively high and then expectations have kind of fallen through the year. And so this yield number, while it's a little bit, again, in the weeds for most people, it is something that's going to be really, really important to pay attention to, and it's going to be something that I'm going to return to again and again in these presentations to kind of keep you updated. Now, once we kind of figure out where we're going to be, which will be in the next month or so, then I won't talk about it as much, because you can see that the yields don't really change that much through the year, although 21-22 was relatively from 1.7 to almost, or 11.7 to almost 12. It's a pretty big spread, but that's bigger than you see most years. I also, again, would suggest that the crushers can optimize for soybean oil yield in the crushing process, or can at least optimize to increase soybean oil yield in the crushing process. And so maybe if oil yields are low and we say, okay, it's going to be 11.7 something, the crushers will do everything they can to bump that yield up. And it may be a situation where throughout the year, we're tending to raise our soybean oil yield a little bit more than we would in the typical year, change it a little bit more than we would in a typical year. So we also will get canola crush for November in the fats and oils report. You can see canola crush, U.S. canola crush is continuing to run above the 5-year average, which is obviously different than we saw last year and not really unexpected. But much like Canada, while we're running above the 5-year average and certainly above where we were last year, we're still below where we were sort of the record year 2 years ago. The big difference here, I think, going forward is going to be the demand for canola oil for biofuel production, and in particular, the demand for renewable diesel production, given the fact that there's now a pathway to create RINs. In the EIA data for October, they reported that canola oil use in renewable fuel production, excluding methanol, went up to like 166 million pounds from about 130 million pounds the couple of months before. What I'm not 100% sure of is whether that reflects an increase in the use in canola oil and biodiesel production, or it is kind of a function of, we had heard anecdotally that renewable fuel producers were starting to buy canola oil in anticipation of the approval of the pathway. I don't think that extended back to October, but it may have extended back to October, and that may explain the sort of the 30 million pound difference. I don't think it would have actually been used in renewable diesel production, although again, we call the EMTS data production. It's really when it gets blended. And so it could be production there with the idea of blending it after the approval. So it could be that that's actually use in renewable diesel production. Currently, I've just allocated it all to biodiesel, but I'm going to dig a little bit more into it and see if there actually is sort of renewable diesel production using canola oil that started in October. If so, that will start to give us a picture of what the demand from renewable diesel producers is going to be going forward. And then once we get sort of data really for January, I think we'll have a really good idea of what we think at least the early steady state for canola oil is going to be. Canola oil, I don't think is going to play a big role for 2 reasons. 1, because it has a relatively high CI score, and 2, because it's relatively more expensive, or usually it's relatively more expensive than soybean oil. We've talked before about how the difference between the RVD price in Los Angeles for canola oil and the RVD price for soybean oil in Central Illinois is essentially 0, or maybe even a slight premium for soybean oil, and so that makes it certainly a lot more competitive than it has been. And so it may be that our expectations for canola oil use in renewable diesel are a little bit low, and we need to raise them up. And if we do that, then I would also expect that maybe U.S. canola crush, and maybe even U.S. canola imports are slightly higher than we would expect. But you can see right now we're forecasting a 616 million pound increase from 21, 22. But again, that may change as we learn more about the demand for canola oil from renewable diesel producers. All right, on to Malaysian palm oil. I raised Malaysian palm oil production pretty significantly this week, just based on the estimates for production in December. There's basically just a 4% decrease from November to December, which you can see based on sort of the 5-year average line, and our projected line now is a little bit smaller than we would typically expect early on in the seasonal decrease in Malaysian palm oil production. And if that's kind of where we are now, given where we see palm oil prices, it may be that palm oil production is going to be stronger than we had anticipated. And the increase took us over 19 million tons. And you can see that it's a little above the 5-year average, sort of going down through the seasonal decline. And then I think if you averaged all of the March through September timeframe out, I think you'd be pretty close to the 5-year average, basically. Maybe just a touch over it, but certainly over where we've been the last couple of years. And that's important because as I was kind of going through stuff this morning, I took a quick look at prices, and based on where our soybean oil price forecast is, if we assume that the spread between Malaysian palm oil and US soybean oil futures is going to continue to narrow through the year, and it's come down to like around 20 cents or so, which has happened a little bit more quickly, and it's fallen a little bit more than I originally expected. As a result, I was just kind of playing around with the numbers, and if we expect it to get back to something like, let's say 10% or 10 cents over the next year, 10-cent premium for soybean oil over the next year, which still would be historically high just for any period other than the last 2 years. If that happens, then that suggests that palm oil prices need to go up to basically 5,000 ringgit by the end of 2023, by the time we get to December, January next year. I don't think that that's where palm oil prices are going to go, especially not if production is going to increase. Now, there are a couple of things, and again, we've talked about the potential bullish scenario in soybean oil. We didn't talk about in canola, but we've talked about before is the low yields in canola oil out of Canada. If we do get into a situation where the world is short vegetable oil, and I think that if beyond those bullish fundamentals, the other one that potentially could happen is the reopening of China, or the shift from a zero COVID policy to sort of letting COVID burn through the population, much like the West has done. We know that probably will take China several months, maybe into the summer, given that this is really the first time that they've kind of allowed COVID to run through the population, or COVID is just running through the population anyway. By the time that they get done and start to get open again, the demand for vegetable oil could increase to the point where you don't have soybean oil available, or you don't have as much soybean oil available. Obviously, are going to have decreased sunflower oil available, and potentially decreased canola oil available. Then, even if palm oil production goes up, the pull on palm oil from China and India could make those numbers come true. Now, by the time that I get through writing the reports and publishing the forecast, I don't think that there's any way that I'm going to publish a forecast that shows that Malaysian palm oil futures go up to 5,000 ringgit. But I do think that there is a chance that that happens, or at least I can construct a scenario where that happens, and you don't necessarily have soybean oil prices rising. Now, if soybean oil prices go up to 70 cents or 75 cents, then I think there's a much better chance, obviously, that palm oil can go up to 5,000 ringgit. I would suggest that probably fair value for palm oil right now is around 4,000, maybe a little bit below 4,000, depending on where production really falls out and depending on how strong export demand is. India has sort of indefinitely extended the zero import duty on palm oil imports, which suggests that maybe the increase that we've seen in demand from India for Malaysian palm oil wasn't just a one-off sort of restocking event, and that finally the significant and long restocking that I've been expecting for seems like a year and a half now might actually start to happen. And so if you get strong demand from India, strong demand from China, even and again, no sunflower oil, canola oil, or soybean oil, or less available anyway, then the increase in palm oil production is going to have a relatively minor impact on prices. Okay, so this week I'm going to write about choice weight grease, and I think the most interesting thing about choice weight grease really is the fact that it is sort of bucking the trend in for fats and greases in total demand for biofuels, total feedstock demand from biofuels. So you can see for 21-22, the demand for choice white grease for both biodiesel and renewable diesel production fell by almost 100 million pounds, and we're now down 220 million pounds, 237 million pounds, I guess, really, from the peak in 1920. We have it kind of flattish, essentially, next year. The tough part about predicting where choice white grease is going to go is the split between renewable diesel and biodiesel. And so you can see renewable or biodiesel demand, based on our sort of split up of the EIA data, declined 170 million pounds from 2021 to 2021-22. But renewable diesel demand actually increased 77 million pounds. And so if we get a situation where renewable diesel really starts to take over or takes the bulk of production in the US, and in a couple of slides we'll see the increase in our expected changes in renewable diesel and biodiesel production in 2023. But let's just assume for a second that renewable diesel capacity shoots way up, and that drives a lot of biodiesel capacity out of business. Then it could be that you do start to see increases again every year in choice weight grease consumption in feedstock use. Which is the situation that seems more likely to me now, and again, I'll kind of go through this over the next couple of slides. If biodiesel production continues to hang around, or biodiesel capacity continues to hang around, and we get an increase in renewable diesel capacity, then it's a question of, does the decline in biodiesel continue? And is whatever the decline is that offset by an increase in renewable diesel usage? And if it is offset by an increase in renewable diesel usage, then again, maybe we start to use more choice white grease. that's a bit of what's happening here. We've got biodiesel production down a bit next year, although I think I'm going to, over the next week or so, I'm going to go through all of that again, and I'll sort of lay out the reasons why in this presentation, and probably increase my biodiesel production, maybe not necessarily at the expense of renewable diesel production. Next week, one of the things that I'm going to focus on is sort of breaking down the mandates and where we see those, and then what our production forecast for 2023 implies about the RIN bank. So the mandates imply some level of production just based on meeting the mandates. But again, if biodiesel capacity isn't going to close down and renewable diesel capacity is going to open and is going to run at 80% or 85% or whatever it is when it opens, which is entirely reasonable to assume, then you could have a situation where you're starting to build RINs as opposed to the last couple of years where we've been drawing them down. And I think that's one of the big questions going forward in 2023 is exactly where we end up in domestic renewable fuel production. And again, a question that I've kind of talked about a little bit in this webinar, is the industry as a whole willing to carry the number of RINs that are at least implied to be produced based on the scenario that I just laid out. Either way, I think it will have important implication for how much choice weight grease is used, and whether we do start to see sort of whether 21, 22 is a bottom, and then we start to see it sort of start to increase going forward. All right, so last week we got the EIA's estimate for renewable fuel production excluding ethanol, for domestic renewable fuel production excluding ethanol in October. Not surprisingly, it was down a little bit from September, just based on the EMTS data that suggested that. I think the more interesting thing about this chart is the forecast for 2023. We've already got EMTS data for November, and again, it looks like we probably are going to get an increase over October. And then we're assuming that the typical seasonal pattern holds in December, and we get another increase. And so that's kind of how we end out the year. But you can tell from the 2023 forecast that we don't really have production growing in the same way that we've seen over the last couple of years, and in particular from 2021 to 2022. The current forecast is based on the mandates and what the mandates would imply for production. And one of the problems with that approach is that it suggests that the renewable diesel industry as a whole operates at an average of less than 65% capacity utilization throughout the year, which is just something that is probably not going to happen. It certainly isn't going to happen, I don't think, in an individual plant level. And if you think about who the companies are that are building the renewable diesel facilities, they're not small companies. They're not in this for a year or two. And ultimately, their competition comes from two areas, one from other renewable diesel companies, but also then from the biodiesel industry. And the renewable diesel industry may need to drive its margins down to levels that limit biodiesel or rationalize biodiesel capacity sooner rather than later. It's going to be tough for them to do. I was talking with a client last week, and they brought up a really good point, which was that the renewable diesel producers, up until we got the collapse in LCFS credit prices, particularly those renewable diesel producers using a low CI feedstock mix, we're able to pay more for feedstock because of the LCFS credit value. And now that the LCFS credit value has collapsed, they're not as competitive as they were before, especially relative to biodiesel. And with biodiesel margins where they are now, even though renewable diesel margins are 2x biodiesel margins, it still doesn't suggest that biodiesel capacity is going to get rationalized in 2023, because if you're a biodiesel producer, your choices for that plant are pretty dire. And so if you're making a dollar a gallon, you're just going to keep operating until something forces you to make that choice. And it doesn't look like there's going to be anything. It looks like the first thing that may force that choice is the switch from the blender's tax credit to the Inflation Reduction Act tax credit. However, I'm still not 100% sure that even that's going to do it. And so I say all that to say that, again, I think that these numbers are probably going to change. That's probably also, it's definitely going to change then feedstock demand. And if you then say we're going to have, going back to soybean oil, if you then say we're going to have strong non-biodiesel demand, we're going to have biofuel feedstock demand that's higher than people expect right now, and yields are going to be lower than they have been the last couple of years, then it's a scenario that can get you relatively bullish soybean oil. I'm not there yet, but the catalyst of the South American crop looms, and that could be the thing that flips my my forecast from essentially flat around 65 to rising. Energy prices will have a lot to do with it, of course, but if I go back to having a hard time sort of making my soybean oil balance sheet work out, then I'm going to obviously I'm going to probably start to raise my soybean oil price forecast. Okay, so this is a breakdown. The last one was the EIA data. This is the EPA data for biodiesel production, and here is what we are currently anticipating for 2023 based on the mandates. Now, again, I think that this is probably the area where I'm going to make some changes. I don't know that I'm going to raise biodiesel production so that it's higher than it was in 2022. And you can see in most of the months from 2021 to 2022, biodiesel production dropped a little bit. There are a couple of months where it's a little bit higher, and I guess I'm expecting it to be higher in December. But the decreases in 2023 are probably a little bit overdone. And so I would suggest just sort of eyeballing this stuff, that it probably, I will raise these by an average of about 10 million gallons a month. So I probably will end up adding, I don't know, 120 or 150 million gallons to our biodiesel production, which would take us back closer to 1.5 billion gallons. It still is, would be the lowest production that we've had in a while. And renewable diesel production is probably going to be higher than that. But I think that 1.39 is probably a little bit too low right now. This is the same data series for renewable diesel, and you can see how much renewable diesel production grew in 2022, and we're expecting that growth to slow in 2023. You can see that from the chart. We've got right now, again, 1.68 billion, so the 1.5 billion in biodiesel production. would be below that, and that would be the first year that we produced more renewable diesel than we did biodiesel. I think even in 2022, we're going to end up, there was a time when it looked like we were going to produce more renewable diesel, but I think it's going to end up, given the fact that that in November we didn't really see an increase. The increase was a little bit smaller than we had expected, and we don't have a huge increase built in for December like we do for biodiesel. It looks like probably biodiesel production is going to be a little bit higher than renewable diesel production in 2022, but in 2023 that will change. Now, having the biodiesel industry and the renewable diesel industry both produce about 50% of production means that competition is probably going to get pretty fierce. And one of the things that we've seen, oddly, is that for the last 2 months, biodiesel prices in California are actually premium to renewable diesel prices. It's unusual because biodiesel is just, if all else equal, biodiesel is just more difficult to deal with than renewable diesel. Biodiesel you have to blend with diesel, where renewable diesel you can just use to replace it, as I'm sure all of you know. And so there should be some premium to renewable diesel just based on that fact alone, and the fact that we haven't seen it, at least in that market. And in that market's a little odd because of the LCFS program and the fact that you're getting these credits. And so we ship like 70% of our renewable diesel production into California versus only 10 to 15% of our biodiesel production. And so all of that kind of plays into it. But I think what it does suggest is that we are, and probably will continue to, narrow the gap between renewable diesel margins and biodiesel margins. And we may need to take renewable diesel margins down to a spot where biodiesel margins go back to zero or negative for an extended period of time, again, because the biodiesel producers don't really have a lot of great options for the plants that they have that are paid for, depreciated, and you know, if they're going to make a penny on a gallon, I assume they're going to continue to produce. Okay, so here's one of the reasons why I think that biodiesel might hang out a little bit longer than expected. And this chart is a little bit busy and not 100% entirely clear, but the point that it makes, I think, is really, really important. So this is essentially the profitability of soybean oil in biodiesel production versus the cost of soybean oil based on our longer term forecasts. And so you can see forever we were kind of around this, 10-cent profitability and 30-cent soybean oil in that market. And now we've shifted out to this market where the profitability is much more volatile and prices are much more volatile, ranging from, I guess, almost 90 cents down to about 45 cents, and with margins that range from basically just a little bit above zero to almost 40 cents a gallon, looks like, in kind of November 21. And we expect that that's probably where we're going to continue to be, even with the switch from the Blender's Tax Credit to the Inflation Reduction Act credit. And the way that we've modeled the Inflation Reduction Act credit, or the value of the Inflation Reduction Act credit, is in very simple terms, we've kind of cut the value in half. There's more. We just didn't say, oh yeah, we'll cut it in half. We did a little bit of work behind that, but the result of that work was about a 50-cent credit instead of $1 a gallon credit. Even with that, so in 2024, there are 2024 months here. Even with that, it suggests that we don't move out of the current range that we're in here, and that biodiesel remains profitable through sort of 2026. And maybe if we kind of take just whether it's going to be 2024, 25, 26, whenever it is, maybe if we just look at the prices and assume that energy prices are going to be somewhere around where they are, or at least where they have been kind of going forward, it would take soybean oil prices above 95 cents to, and this is RBD soybean oil, Central Illinois, so it's cash soybean oil, not soybean oil futures, above sort of 95 cents and probably closer to $1 before you get biodiesel margins back to zero or to negative numbers. And so our forecast in this chart, honestly, is a little old. I was trying to look for it to update it before I started the webinar this morning, but I haven't been able to find where I buried this one yet. And I will update it. This will be a chart that we'll come back to again and again. But it does suggest that there probably is some time, and that biodiesel producers probably hang out for longer than expected, and potentially longer after the switch to the Inflation Reduction Act credit than anticipated. Now, the key to this, beyond energy prices and soybean oil prices and all of that, I think, is how quickly does renewable diesel production capacity come online? And so what this chart kind of shows is that the gray line here was the June 2020 prediction for the growth in renewable diesel capacity. And while you can see that the increase, the slope of the line hasn't really changed, at least in the realized, or hasn't changed significantly in the realized increase in renewable diesel capacity, that there's been a lag relative to what we expected a couple of years ago. And so that is something that could continue to happen. Now, the other important thing to note is the significant increase in renewable diesel capacity and sort of the terminal rate of renewable diesel capacity. And we don't think that this is a terminal rate forever, but it's the terminal rate based on the announcements that we've had so far. So if that at some point, the amount of renewable diesel capacity that we have relative to the amount of biomass-based diesel that we need to produce is going to be so great that it's going to drive biodiesel producers out of business. Even, I guess, unless margins just are absolutely the same, or biodiesel margins are even higher than renewable diesel margins on some level. I don't really think that that's going to happen, biodiesel margins above renewable diesel margins. Because as more renewable diesel capacity comes on, it's going to pressure more and more biodiesel capacity. And so I think ultimately the end game for biodiesel producers is the same no matter when it occurs. But the question is, when does it occur? And this purple line will have as much of an impact on when that occurs as the prior chart, the soybean oil price or the feedstock price, essentially, in profitability. If the increase happens more quickly, if by the time that I update this chart again, if we get a shift back towards the right in this this run up in sort of 2023 over the next year or so, then that will put more pressure on biodiesel production, and that could make the rationalization happen, even if I'm sort of still projecting out biodiesel profitability, just because, and I almost couldn't do that because the greater renewable diesel capacity implies more feedstock demand, higher feedstock prices, and that will take biodiesel margins down. So it's almost impossible to do those two things together. And that's why this chart, I think, is really important. And again, this is one we won't look at every week, but we probably will look at this once a quarter or so, just to kind of keep in line with where our expectations are about renewable diesel capacity and when it's coming online. And then there's some other charts that I have that are kind of, I think there's an important question about what this increase in capacity looks like relative to the increase in feedstock capacity, which really comes down to the increase in soybean crush and soybean refining. And that's a project that I've been working on with a client for a long time, trying to get the exact right representation of that. And it's something that it seems like it would be relatively straightforward to do, but it's been something that, quite frankly, I have honestly struggled to sort of represent in a way that's simple and easy and tells the whole story. And this is just half the story here. Okay, well, we got the EIA feedstock data for October, and I put this chart in here just to kind of show the shift in the feedstock mix over the last couple of years. And so green is soybean oil, yellow is DCO, and then orange is used cooking oil / yellow grease. Those three feedstocks basically make up about 80% of the total feedstock mix. And the important bit, I think, is to look at the change from, this is January 2020, this first number. You can see about 45.8% soybean oil, a little less than 20% distillers corn oil, and a little bit more than 10% used cooking oil and yellow grease. And these numbers move around every month, but I kind of highlighted every 6 months, where are we going? And you can see sort of in the long term, a couple of trends here. One, slight decrease in soybean oil, slight decrease in DCO, as you're getting an increase in yellow grease, used cooking oil. For the most part, the other feedstocks generally are have not changed significantly. Choice weight grease may be the one exception, where it used to make up a bigger percentage of the total feedstocks, and that has kind of shrunk. And poultry fat also had its day in the sun in sort of early 2021 and has kind of fallen off. Now, a bit of that may be a function of bird flu. So maybe poultry fat starts to come back a little bit, although poultry fat is probably the most difficult feedstock to work with, because of the free fatty acid profile for poultry fat. And so I don't know that I think that poultry fat's going to come back in a big, huge, significant way, even as we rebuild the domestic bird flock. And really, again, I wanted to focus on the three that basically made up the 80%. And so you can see we got data for October. So in October, it was 48.8% soybean oil, 11.9% DCO, and 18.7% UCO. And I left the last 6 months on here just so you could kind of see a bit how these move around. And so you can see that yellow grease UCO has been in the 20s and then dropped off to 18%, and DCO has been in the 13s and then dropped to about 12%. And that was because soybean oil kind of came back up. And I think part of that probably in October was when we started to see sort of the break in soybean oil prices, and the fat and grease prices didn't really follow at first. They kind of continued to hang out at or close to record highs. And so soybean oil was probably relatively a little bit less expensive. That said, we think that we probably hold there and kind of increase into the end of the year, primarily because as you get over a certain threshold on any given month of just production, there's only so much fat and grease that's available. And so then you have to go to vegetable oils. And so soybean oil then picks up share, not because it's favored or there's a change in the trend, but just because you're producing so much in a given month that you're going to have to use more soybean oil to make that. You can see here for vegetable oils in 2022, even though we had the big expansion in renewable diesel production, and obviously everybody is trying to get the lowest CI score that they possibly could get. Vegetable oil still, which soybean oil and canola oil, still made up more than 50% of the total feedstock mix. We can talk a little bit about yields again here. I'm not going to talk too much about this. This is the yields implied by the EIA data. Mostly what I wanted to do is kind of show a difference. And so this is the EIA feedstock data versus the EMTS data from the EPA. And you can see, and we talked a little bit about this before, you can see that the average over the last 5 years in the 5-year range kind of goes from about 7 pounds a gallon to 7.5 pounds a gallon, or a little bit more than that. And that doesn't necessarily make intuitive sense. Now, the January numbers are odd, I think, because January tends to be a lower EMTS month. Again, I talk about EMTS as if it's production. It's actually blending. And so there's less blending in January. And I think the reason that you get the big yields in January is it probably has more to do with a mismatch between the production and the actual blending than it does anything else. But if you just look at the rest of it, you would say, okay, 7.5 is maybe a little bit low, given that that's what we think of as the conversion rate for soybean oil, and fats and greases are generally a little bit higher for biodiesel, and then can be significantly higher for renewable diesel. And so as renewable diesel makes up a bigger percentage of the total production, that you would expect that this average yield would rise. And we've seen that a little bit, especially sort of in the second half of the year. And so that kind of makes sense. That's as we're increasing renewable diesel production from whatever level, that the yield is going up, because fat and grease yields for renewable diesel tend to be higher, or the amount of fats and greases required to produce a gallon of renewable diesel is higher than it is for biodiesel. But still, all in all, I think you would say that these implied yields are a little bit low. And again, that's probably more to do with the fact that the EPA data is really a blending series rather than a true production series. And so we're kind of a little bit matching, not apples and oranges, but maybe two different kinds of apples, I guess, here. However, when we look at the EIA feedstock data against the EIA production data, so all renewable fuel production excluding ethanol, surprisingly what we see is a 5-year average that is up around 9 pounds, which is kind of the upper limit of the feedstock conversion rates, or at least the feedstock conversion rates that we've been able to figure out from the industry and talking to people and that kind of thing. However, again, at least they are sort of moving back in the right direction. And so for last year, if you look, we are back towards the kind of the EPA implied yields, where we're kind of 7.5, give or take, somewhere in there, and then kind of fell down at the end of last year, 2021. I guess that's 2 years ago now. And then in 2022, they came down further and kind of averaged 7. And so that's probably a little bit low. It's also odd that you get this volatility in yields for the EIA data when comparing it to its own production data. So we should remove any of the difference in production timing versus blending that we have in the EMTS data. So these should actually be real yields. In addition, the EIA production isn't just renewable diesel, biodiesel, and co-processing. It includes naphtha and some other things. And so you would expect that that the yields would actually be lower, because if we're just counting renewable diesel, biodiesel, and co-processing, then that's one total. But then if we add anything else to that, and we keep the feedstock number the same, that means that there's more fuel produced per pound of feedstock than there is just for the biomass-based diesel categories. From that perspective, the 7-pound average probably makes a little bit more sense, because we are including these other things in there that are adding or reducing the amount of feedstock per gallon of production. I think what I may ultimately do is start to subtract just to make it more confusing, take the EIA data, subtract naphtha and some of the other things out of the EIA data. Take the EPA, naphtha production, and other categories, subtract those out, and then see what yields look like. But I thought this was just interesting, if for no other reason than you have sort of the EPA implied yields around 7 for the 5-year average, or 7.5 for the 5-year average, and the EIA actual yields compared against EIA production, the 5-year average is around 9. All right, that is the end of the show, of the slideshow for this week. Again, that ran super long. Okay, I'm going to try to make this not run so long. The point of this slideshow was to reduce the length of time that I babble on, not increase the amount of time that I babble on. It'll take me a little while to figure out how much I should know how much I talk per slide, but I tend to ramble even when guided by slides. So it is something that's in process. Again, sorry about not sending out the link this week and not setting this up. I think I just was looking and went through and deleted all of the webinars after Monday holiday, and I just took this one out, not thinking that it would be 2 weeks in a row that we didn't have a webinar, and I didn't really want to do that. So hopefully you'll be seeing this through a link that I send you in your email. If not, then next week will be fresh for you, and the new format will be a surprise, and hopefully a little bit tighter and a little bit better. All right. Thank you, everybody, and Happy New Year. And I look forward to seeing you all next week.